Hi, this is Huang Lei, CFP and EA in California. In this video, the focus is on which assets should pass by beneficiary designation, or TOD, and when that works well versus when it can quietly damage the estate plan. First, the basic rule. Some assets are designed to pass by beneficiary form, not by the will. The biggest examples are retirement accounts such as IRAs, Roth IRAs, 401ks, and 403bs, along with life insurance policies. For retirement accounts, ownership normally stays in the individual's name while primary and contingent beneficiaries are named on the account paperwork. That is how tax deferral is preserved and how the assets pass directly at death. A trust can also be named as beneficiary when more control is needed, such as for minor children, special needs planning, blended families, or beneficiaries who should not receive assets outright. Life insurance works in a similar way. The beneficiary can be a spouse, children, another individual, or the trust. If the goal is to manage the money over time instead of paying it all out immediately, naming the trust often makes more sense. Now let's talk about POD and TOD accounts. POD means payable on death and is commonly used on bank accounts like checking, savings, and CDs. TOD means transfer on death and is commonly used on brokerage or investment accounts. These designations usually allow assets to transfer directly to named beneficiaries without probate. That can be useful in the right situation. For example, a checking account may be made POD to a spouse for fast access to cash. A smaller TOD investment account may also work well if the beneficiaries are responsible adults and the owner wants a direct transfer. But there is a common mistake. Some families try to do the entire estate plan using only POD, TOD, and scattered beneficiary designations. That can leave the trust or probate estate with too few assets to pay debts, taxes, expenses, or equalize inheritances among children. There is another risk. If a minor, disabled person or financially irresponsible beneficiary receives money directly, the result can be guardianship issues, benefit problems, or loss of asset protection. In those cases, naming the trust as beneficiary is often the better planning decision. Here is a practical framework. Use beneficiary designations for retirement accounts and life insurance because that is how those assets are designed to pass. Use POD and TOD selectively for simple accounts where a direct payout is truly appropriate. Use the trust whenever control, protection, staggered distributions, or family complexity matters. The bottom line is that each asset should point to the right destination. Some assets should go to the trust, some should pass by beneficiary, and some are left for the will to catch. The goal is not just to avoid probate, but to make sure the estate plan actually works the way the family intends. If you want more videos on how ties, investments, real estate, and estate planning all fit together, hit like, subscribe, and drop a comment.